Hedging your positions is a cornerstone of effective risk management in the financial markets, and yet it is often misunderstood or underutilized by traders who focus solely on profit. At its heart, hedging is not about chasing gains, it is about protecting what you already have, ensuring that a single unexpected event or market swing does not undo months or years of careful trading. When you hedge a position, you are essentially creating a safety net, a counterbalance that helps to stabilize your portfolio and give you confidence to operate even in volatile conditions. Imagine holding a significant position in a highly volatile market, whether it is currencies, commodities, or equities. Without hedging, any sudden shift in the market could have devastating consequences. Hedging allows you to offset these risks by taking positions in related instruments that gain value when your primary investment faces losses. The goal is not to eliminate risk entirely, that is impossible in trading, but to manage it so that your portfolio remains resilient and your overall strategy is not derailed by a single adverse move. Consider the scenario of Sarah, a commodities trader specializing in crude oil. She manages both physical holdings and futures contracts in the oil market, a market that is notoriously susceptible to sharp swings driven by geopolitical tensions, supply changes, and global economic conditions. In early 2020, Sarah recognized the potential for a significant drop in oil prices due to emerging geopolitical conflicts and oversupply concerns. Rather than leaving her portfolio exposed, she implemented a sophisticated hedging strategy to protect her positions. Sarah began by selling crude oil futures contracts equivalent to her physical holdings. This action created a counterbalance, as the value of her physical oil declined. The futures contracts gained in value, offsetting the losses. Recognizing the possibility of extreme moves in the market, she also purchased put options on crude oil futures, giving her the right to sell oil at a predetermined price. This additional layer of protection ensured that even in a sudden collapse, she could limit her losses and maintain control over her financial exposure. To further diversify her hedge, she invested in an inverse oil ETF, a financial instrument designed to increase in value when the underlying oil price falls. By combining these strategies, Sarah had constructed a multi-layered defense that safeguarded her portfolio from a variety of risks. When oil prices did indeed plummet due to the COVID-19 pandemic and an international price war, Sarah's hedging strategy proved invaluable. While her physical holdings suffered losses, the gains from her short futures positions, the increase in value of her put options, and the profits from the inverse ETF collectively neutralized the impact of the downturn. By the end of the year, her portfolio remained stable, and she was able to navigate one of the most turbulent periods in oil trading history without catastrophic damage. This example underscores the practical importance of hedging. It is not a theoretical concept but a tangible, actionable strategy that can protect traders and investors in real market conditions. Hedging is not limited to commodities. It applies across asset classes and markets, from equities and currencies to bonds and derivatives. Traders can use a range of instruments to achieve similar protection. Forward contracts allow them to lock in prices in advance, futures contracts standardize these agreements for easy exchange, options provide flexibility with rights but not obligations, and swaps enable the exchange of cash flows to manage interest rate or currency risk. Each of these tools serves the same essential purpose: to reduce exposure to potential losses and maintain stability in uncertain markets. What makes hedging particularly powerful is its combination of financial protection and psychological comfort. Markets are inherently unpredictable, and even the most skilled traders face unexpected events. Knowing that you have implemented hedges allows you to make decisions more rationally, without panic or fear influencing your choices. It creates the mental clarity needed to stay disciplined and follow your strategy, even when volatility spikes. This mental resilience is just as important as the financial protection itself because emotional decision-making often leads to mistakes that erode both capital and confidence. A disciplined hedging approach requires thoughtful planning and ongoing monitoring. Traders must assess their exposure continuously, adjusting their hedges as market conditions evolve. In some cases, a hedge that was appropriate at the start of a trade may become insufficient or excessive as prices move and volatility shifts. Effective hedging is dynamic, not static. It evolves with the market, protecting your positions without unnecessarily capping potential profits. The balance lies in selecting the right instruments, determining the appropriate size of each hedge, and timing the implementation to align with market conditions and overall strategy. The lessons from Sarah's experience also highlight a broader principle: hedging is an investment in resilience. It does not make trading risk-free, but it ensures that losses are manageable and that your portfolio can withstand shocks without derailing your long-term objectives. Traders who master hedging are able to maintain consistent performance even in turbulent periods, preserve capital, and continue operating with confidence. They understand that trading is not about avoiding risk entirely but managing it intelligently to sustain growth over time. Ultimately, the practice of hedging reinforces a disciplined mindset. It encourages traders to think strategically, anticipate potential scenarios, and act proactively rather than reactively. By making hedging an integral part of your trading strategy, you protect your investments, reduce anxiety, and foster the long-term stability necessary to thrive in financial markets. Hedging is not a shortcut to profit, it is a commitment to consistency, prudence, and resilience. Those who embrace it position themselves to endure volatility, recover from setbacks, and achieve sustainable success in the complex, ever-changing world of trading.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.